Last year, something bizarre unfolded at Bank of Baroda branches. Gold loans, yes, those loans backed by actual physical gold were being handed out without any gold at all. Crazy, right? Here is how it went down. Some Bank of Baroda employees, desperate to meet their loan targets, cooked up shady scheme. They teamed up with a few customers and disbursed loans without any gold as collateral. But the customers weren't actually receiving the money. The employees blocked the access to the funds and changed the repayment dates to keep everything looking legit. No real money moved around, just inflated loan figures on the paper. They even used bank's internal expense account to cover up the processing fees. It wasn't until Bank of Baroda's internal auditors noticed that many of these gold loans accounts were being opened and closed on the same day that alarm started going off. And it wasn't just Bank of Baroda. Earlier this year, the RBI temporarily banned IIFL Finance, another big player in the gold loan market, from disbursing loans. They too were bending the rules, undervaluing gold, offering loans above permissible limits, and ignoring regulations. Both BOB and IIFL admitted there were issues and promised to fix them. But RBI was suspicious, so it started digging deeper into the gold loan practices across the sector. What it found was shocking. Many banks have outsourced their gold loan process to fintech companies to speed things up. But in doing so, they cut crucial corners. Some fintechs even skip face to face gold valuations as a key step to securing these loans. Then there is a loan to value ratio issue. The LTV ratio determines how much money you can borrow based on the value of the gold. If the gold prices fall, the loan becomes riskier, but many banks weren't monitoring these fluctuations carefully. This negligence the risk of the defaulters higher. Another shady practice was evergreening. Lenders kept renewing loans without trying to recover the money, making their books look healthier than they actually were. These banks were also fast and loose with the auction rules. When borrowers could not repay, banks auctioned off the gold but did not always return the leftover money to the customers as they should have. Even more suspicious as that many gold loan accounts were closed almost immediately after being sanctioned. Why would someone take out the loan and close it right away? Something wasn't adding up. The RBI also discovered some borrowers were taking multiple loans using same PAN number within a single year, gaming the system. Valuations issues were rampant too. Gold is supposed to be assessed by weight and purity before loan is advanced. But some lenders inflated the purity of the gold, saying valuing 20 carat gold as 22 carat, which led to higher loan amounts. When gold was eventually auctioned, the lenders lost money because auction price was reflected the real and lower value. And then, in one case, IIFL Finance had over 1.9 million gold loan customers. When RBI reviewed some of these accounts, it found 67% of the gold valuations were inaccurate. This was a massive problem, especially when it comes to time for recovering funds. Faced with these revelations, the RBI gave banks and NBFCs, non-banking financial companies, 3 months to clean up their practices. They were ordered to review policies, fix gaps, and better monitor the third-party services they were using. But how did it got all messy? Gold loans became a lifeline for many people needing quick cash. Borrowers often urgent situations, typically outloing loans from 60,000 to 1 lakh after COVID-19 demand surged, and this became exploded during the recent years that led to these scams.